Right now, a financial shockwave is rolling across the globe. Stock indexes are flashing red, bond yields are jumping, and a deep sense of anxiety is gripping trading floors from New York to London. But this panic isn't starting on Wall Street, it's starting in Tokyo. For decades, a hidden multi-trillion-dollar flow of money out of Japan has been propping up the price of just about everything, from your stock portfolio to global real estate. It was the biggest and maybe the most dangerous open secret in finance, a trade that made borrowing money almost free, fueling a worldwide boom in assets. But now, after 30 years, Japan has flipped a switch. The free money is gone, the engine that powered the global market is violently lurching into reverse. And this isn't just a Japanese problem, it's a global one. This is the story of the great unwinding of the yen carry trade, and it's threatening to pull everything down with it. The chaos is just beginning. To get the panic, you have to get the scale. Imagine a single source of funding so huge that its reversal could trigger a global cash crunch. This isn't a theory. For years, investors from the biggest hedge funds all the way down to individuals borrowed Japanese yen for practically nothing. They took this nearly free money and bought higher yielding assets all over the world. US government bonds, tech stocks, European real estate, you name it. This strategy, known as the yen carry trade, became a quiet cornerstone of the global financial system. It was a silent subsidy for taking risk. Now that subsidy has been yanked. The Bank of Japan is raising interest rates, and the consequences are rippling outwards with terrifying speed. Investors are being forced to sell their global assets to pay back their yen loans, which are suddenly not so cheap anymore. This massive forced selling is exactly what's making Wall Street panic. They aren't just worried about a dip, they are worried about the systemic collapse of a trade that's been baked into the market's DNA for decades. So how did we get here? How did one country's currency become the linchpin for a multi-trillion-dollar global debt? Well, the story starts not with a bang, but with a long, slow fizzle. Back in the 1980s, Japan was an economic powerhouse. Its stock market and real estate soared to unbelievable heights. And for a little while, the land under the Imperial Palace in Tokyo were supposedly worth more than all of California. It felt like the boom would never end, but in 1991 it did. The bubble didn't just burst, it exploded, plunging Japan into an economic funk so deep it became known as the last decade. Japan was fighting a strange and stubborn enemy: deflation. Deflation is the opposite of inflation we're all used to. It's when prices keep falling. Sounds good, right? But for an economy, it's a death sentence. When people think prices will be lower tomorrow, they stop spending today. Why buy a car now if it's cheaper in 6 months? This hesitation crushes companies' profits, which leads to lower wages and layoffs, which makes people spend even less. It's a vicious downward spiral. For 30 years, the Bank of Japan tried everything to stop it. It slashed interest rates, hoping to get people borrowing and spending. It wasn't enough, so they did the unthinkable. They introduced a zero interest rate policy. They literally made money free to borrow. When even that didn't work, they went a step further into bizarro world with a negative interest rate policy. This meant banks were actually charged for parking extra cash at the central bank. The whole point was to force money out in the economy. At the same time, the Bank of Japan started a huge program of quantitative easing, or QE, buying up trillions of yen worth of government bonds to flood the system with cash. They were pumping money into the economy on a scale nobody had ever seen. But while these crazy measures failed to create a real growth at home, they did something else entirely. They created the perfect setup for the largest carry trade in history. For investors around the world, Japan had just become a bank offering free money, and Wall Street was first in line. The yen carry trade sounds complicated, but the idea behind it is actually dead simple. It's all about playing the interest rate game between two countries. Here is an analogy. Imagine you could go to the bank in Tokyo and get a loan for $1 million at a 0.1 interest rate. Your annual interest payment is just $1,000. Now you take that million, swap it for US dollars, and stick it in a US government bond. That pays you a 4% yield. That bond earns you $40,000 a year, so you pay the $1,000 interest on your Japanese loan and pocket $39,000 in pure, almost risk-free profit. Now scale it up. You're not just a regular person, you're a slick hedge fund. You don't borrow 1 million, you borrow 1 billion. And you don't just buy a simple bond, you use leverage, borrowing even more against your position, sometimes at ratios of 10 to 1 or more. That $1 billion position could be controlling $10 billion in assets. The profits become astronomical. That, in a nutshell, was the yen carry trade. For decades, it was the financial world's money printing machine. This flood of yen poured into every corner of of the global market. It bought US tech stocks, helping fuel the Nasdaq's meteoric rise. It bought European corporate debt, lowering borrowing costs for companies. It flowed into emerging markets, real estate, and even speculative assets like crypto. Japanese investors themselves became the largest foreign holders of US debt, buying over $1 trillion worth of treasury bonds. This had a huge market warping effect. The constant demand from carry trade investors pushed asset prices artificially higher. It squashed volatility, it made risky bets feel safe, it created a sense of stability that was really built on the fragile foundation of Japan's zero interest rate, quicksand. The entire global financial system got hooked on this flow of cheap yen. And for years, as long as the Bank of Japan kept the taps on, the party raged. But now the music has stopped. For the first time in a generation, Japan is seeing real inflation. After decades of trying to make prices go up, they finally are. Japan's core inflation hit 3% in October 2025, staying well above the Bank of Japan's 2% target. This forced the central bank's hand. The era of free money had to end. The shift started in 2024 when the Bank of Japan finally ditched its negative interest rate policy. Then in January 2025, it hiked its benchmark rate to 0.5, the highest in over 17 years. It also started to slow down its massive bond buying program. These weren't just small tweaks, they were big shocks, and in response the yield on 10-year Japanese government bonds surged, climbing to over 1.88% by early December 2025, a level not seen since 2008. Suddenly, the easy math of the carry trade got flipped on its head. That loan that was almost free now has a real and rising cost. The interest rate gap between Japan and other countries started to shrink, squeezing the trade's profitability. But the real danger came from the currency itself. As investors bet on more rate hikes from the Bank of Japan, they're buying yen, making it stronger. For carry traders, this is a total nightmare. They borrowed in yen, but their assets are in dollar and euros. Now they have to pay back their loans in a currency that's getting more expensive, while the foreign assets they own might be falling in value. This kicks off a devastating feedback loop. The rising cost and currency risk forces traders to bail on their positions. To do this, they have to sell what they bought. The US stocks, the European bonds. They sell these for dollars and euros and then use that money to buy yen to repay their loans. This mass selling pushes down global asset prices, while the mass buying of yen makes the yen even stronger, causing more pain and forcing even more selling. This is the unwind. It's a chaotic self-feeding exodus from global markets. We're already seeing the impact. Global bond markets have been thrown into turmoil, with yields rising worldwide in response to Japan's move. And we've seen a preview of what forced selling can look like. In October 2025, a sudden geopolitical shock tied to US-China tariffs triggered a catastrophic flash crash in crypto markets, wiping out over $19 billion in leveraged positions in a single day. While caused by a different trigger, it's a terrifying example of how quickly leveraged trades can blow up and cause a market meltdown. The fear on Wall Street is that this is just the first tremor of the great yen unwind. Since it's hard to track the exact size of the carry trade, with some estimates in the trillions of dollars, its unwinding could trigger a liquidity crisis, an event that historically makes financial crises much worse. The big question now is what happens next. While the Bank of Japan is in a tough spot, in early December 2025, Governor Kazu Ueda gave his clear signal yet that the bank is seriously considering another rate hike at its policy meeting on December 19th. He spoke of needing to adjust policy as appropriate, and market took the hint, pricing in a high probability of another rate increase. This put global markets on a knife's edge. Every word from the Bank of Japan is being put under a microscope. Another hike could speed up the yen's rise and intensify the carry trade unwind, sending another shockwave through stocks and bonds. Holding rates steady might offer a moment of relief, but could also make the bank look like it's falling behind on inflation. The bigger picture is that a fundamental piece of the global financial system is being dismantled. For 30 years, the world's markets ran on an invincible subsidy from Japan. That subsidy is gone. We're entering a new reality where money isn't artificially cheap and risk is being repriced in real time. What does this mean for you? Well, first, expect more volatility. This unwinding won't be a smooth ride. As huge funds are forced to sell off trillions in assets, we're going to see sharp, unpredictable swings in currency, stocks, and bonds. Second is borrowing costs will likely rise everywhere. Japan was a massive buyer of foreign debt, especially US treasuries. As Japanese banks and pension funds bring their money home to invest in their own newly attractive bonds, they'd be selling those foreign holdings. Less demand for US debt means the US government has to offer higher interest rates to find buyers. And that eventually translates to higher borrowing costs for everyone. Finally, this could mark a long-term change for the Japanese yen. After decades of being the world's cheapest funding currency, it could re-emerge as a strong normal currency, fundamentally changing how money flows around the globe. And if you found this video helpful, don't forget to like and subscribe, and I'll see you guys in the next video.